Leading metal forging auto ancillary Bharat Forge has posted an in-line set of numbers for the third quarter of FY22. Performance during the reported quarter got impacted due to weak CV export revenues on account of the semiconductor shortage. Realizations, however, helped the company to arrest the impact of lower volumes. Medium to long-term demand outlook for the domestic business looks quite promising given the pent-up demand and an increase in economic and industrial activities. Demand momentum in international markets is expected to continue and new focus areas are likely to drive growth in the coming years. If we look at the Q3 numbers, the company reported a quarter-on-quarter decline of 6.5% in its total volumes, led by weak CV export revenue, which was down almost 20%. CV exports were down due to chip shortage. Realizations, meanwhile, improved 7.4% on the back of rich product mix and price hikes taken by the company. Raw material prices continue to put pressure on EBITDA margins, which contracted by 475 basis points on a QoQ basis. Though there's still some uncertainty regarding end demand because of supply issues pertaining to semiconductors, demand post the second wave of COVID-19 has recovered sharply. The management has indicated that the domestic auto sector is expected to continue to perform strongly. High pent-up demand, preference for personal mobility and first-time buyers will continue to fuel strong demand for passenger cars, which will have a positive spin-off effect on the company. Moreover, the management is very optimistic about the demand from CV segment as it expects construction, mining and infrastructure activities to pick up with opening of the broader economy. It has guided to an increase in demand every quarter going forward. For the industrial segment, the company expects business to grow meaningfully with the revival in capex cycles and the potential opportunities arising out of various PLI schemes and defense manufacturing in India. Production of heavy trucks in North America continue to get impacted due to a severe shortage of semiconductors. However, there are signs of easing of the supply side constraints. Management expects the production to improve going forward. Similarly, demand is very strong for the passenger vehicles market, but supply constraints and higher freight costs are impacting production. The industrial segment is also turning around with a recovery in oil and gas. With crude prices hovering around the $80 mark, the viability of the shale drilling industry has improved and prospects over the few quarters look very strong. Management continues to focus on the growth areas that it has identified: electric vehicles, lightweighting and defense. In the EV segment, Bharat Forge plans to focus on components, subsystems in the areas of power electronics, control electronics in the entire battery management system for both low voltage, extremely small LCVs and intermediate high voltage LCVs. The lightweighting business has started ramping up aggressively as well. The aluminium forging business in Europe and the US is expected to increase from the present $70 million to $250 million in the next few years. In fact, the company is witnessing strong traction of its EV products. In the first 9 months of the current fiscal year, Indian operations has secured orders worth $100 million, of which $50 million are for EV platforms across export and domestic customers for EV powertrain components. Management has also highlighted that the defense business is seeing strong traction. In fact, the company has received orders from the government that are expected to be completed in the next 2 quarters. The company is also setting up facilities for specialty vehicles, systems and aggregates and assembly and testing for vehicles and artillery guns. Any demand weakness in international and or domestic markets could hurt the company, so an important risk to watch out for. Moreover, an adverse commodity price movement would increase raw material costs and impact the company's operating profitability. But meanwhile, if we look at the valuations, the stock is trading at a valuation of 21.6 times FY23 projected consolidated earnings, which we believe is at a reasonable level given the strong growth potential. We advise investors to buy and also accumulate the stock at lower levels.